And another interesting thing to ponder here, and again, you've seen this you've gone through so many cycles and so many things with central banking and economies. It's not quite 10 years, but we're coming up on a decade since the financial crisis started economies and financial systems unraveling, and then central banks jumped in with super aggressive rate cuts, and then all these unprecedented measures. Here we are, and they're trying to make a big shift, but they're having trouble. Why?
Well, the fact is that indeed about a decade ago, when the mega crisis broke out, there was a great consensus of what needs to be done. And all central banks together have lowered their interest rates to unprecedented low levels. Fiscal policies got expansionary all over the world, and the objective was to prevent a calamity. And it was successful. Interest rates remained low, QE has been expanding, and etc. We are now in 2017. I want you to imagine, is there a single central banker who a decade ago believed that when we meet here in Jackson Hole in 2017, this will be the subject, that interest rates will be still so low, that quantitative easing will be still so expansionary? So the fact of the matter is that this has taken much longer than everyone expected. It was successful, but like every policies, there is diminishing returns. And with the passage of time, as real interest rates became negative for such a long period of time, practically all over the world.
But Jacob, wouldn't most central bankers not think that, oh my gosh, low interest rates, these extraordinary tools, unemployment's falling, Japan record low rate, et cetera, that inflation would be so stubbornly uncooperative, that it would be lower than central banks want it to be, far from target? Would they have expected that? And isn't that the big, big conundrum now?
They have not expected it, and it is still a puzzle to many, but we need to remember one important thing. Other things happen in the background. While you are only watching the inflation and you are saying we are still not there, let's not restore yet normalcy, in the meanwhile, a lot of negative consequences, unintended, are happening in the background. When interest rates are so low and negative in many cases, investors are looking for alternatives. They are chasing after returns, and with it, high risk. Corporations are buying back their shares instead of investing in plant and equipment. There is a disconnect between the real and the financial sector. There is a danger of the creation of bubbles. And all in all, when we are sitting here, we are first puzzled about the low inflation, but we are also puzzled about the low productivity and somewhat subpar growth. And the question is, aren't they interrelated?
In what way? How are they interrelated?
Is there a possibility that the low productivity that we have is in part a consequence of the fact that investments are being put in the financial sector rather than in the real economy? Is it part of the fact that the interest-sensitive sectors like housing have been encouraged, and those happen to be the low productivity sectors? We still have a puzzle, but I really want only to urge to say that inflation is not and should not be the only gauge for monetary policy, because suppose that I told you that inflation we will not be able to raise it to 2%.
Some people
is
think
this a license to continue and continue and continue with the low rates and with the easy monetary policy? Nobody would say that. So I would only say, and I believe that that's the reason why the Fed has already started in its normalization, and I strongly encourage it. And I think it's good news. The Fed that has been so prudent for so many years, if it starts now and continues in raising rates and in dealing with the balance sheets, the markets will see this as a very positive signal.
Okay. Now, Janet Yellen is going to speak about financial stability tomorrow. Now, that could be that she wants to avoid speaking about interest rates or the balance sheet, it could be that maybe that we've seen little hints of this in the FOMC minutes and some comments by Fed officials. They're looking at stock market valuations, right? You kind of wonder, is she going to have something to say along the line of rates too low for too long, reaching for yield, and a concern that, that it maybe doesn't matter so much, or maybe implicitly inflation doesn't matter so much as what you're saying, and maybe financial stability is what the Fed has to safeguard by moving?
Well, I believe that, like in the past, this was not, Jackson Hole is the place that gives the opportunity for a reflective statement by leaders of the monetary authorities of the world. It's not the place to announce the yesterday's decision of the FOMC or something like this. And I think that, like we saw in previous years, in Bernanke's time, in Greenspan's time, and now in Janet Yellen's time, it is used in order to provide us with a better understanding about the way the Fed thinks and reflects. And you cannot but be impressed by the fact that the considerations are much wider and much broader than what comes occasionally in the narrow financial press. Let me just say, we should not look at the data of yesterday to forecast the policy of tomorrow. It is the data of the entire range of period, and the perspective should be a medium-term perspective, and that's what the Fed is supposed to be doing.
Mario Draghi at European Central Bank, very different point from the Fed and the U.S., or not?
Well, the Central Bank of Europe has a different challenge. Europe has a different challenge. European governments are so different from each other. The real economies are so different. The unemployment in Europe is about the 9.1%, and there is a great dispersion. Greece and Spain on the one hand of more than 20-25%, and Germany is on the other hand. So he has a big challenge. The fact in Europe is that the challenge is inflexible economies, structural policies that are delayed, and overburdened monetary policy. And by the way, the overburdening monetary policy is not the monopoly of Europe. The US is the same. The fact of the matter is, we are talking about monetary policy because we are here in Jackson Hole. But the fact is that if we want to promote investment, productivity, and growth, the solution is not in the hands of central bankers. The solution is in the appropriate budget policy, in tax system, in structural policies, policies that eliminate distortions, policies that make the economic system more flexible and encourages to think about the future. That's where growth will come from.
You are concerned about rates being too low, too long. You think central banks have too much weight on their shoulders. But bottom line, I think what everybody wants to know, Fed's kind of looks like it's backing off potentially from another rate hike this year. Do you agree? Do you think they should?
I believe they should raise rates. Everyone expects it to happen. It is on the journey for normalization, and the cost of an error is relatively low to a cost of an excessively long delay. Because while we are keeping rates as low as they are, there are issues in the financial markets and other distortions that get accumulated. Don't forget, we are already a decade or so into this mode, and the normalization is called for. The economy is improving significantly. Labor markets have not been as well behaved, so to speak, as they have recently. Unemployment rate is low. The duration of unemployment has declined. Even inflation on a medium-term perspective is getting towards the target. I would not hesitate at all. In fact, I would definitely vote for a hike.
In September? September?
Not a single move. Let's remember, we are talking about a journey. The journey is restoring normalization, and this will be several hikes. And as it was already indicated by the Fed, this journey is going to be slow but consistent. So there will be need to be quite a few rate hikes, moderate in size during 2018, and we should not wait much longer than 2017.
What do you tell the people who say, and especially a lot of people in markets, it's like, wait a minute, go slowly. You may be right that we need to normalize and get back to not having the central banks with these big balance sheets, but guess what? the central banks created these big balance sheets. They put the liquidity into the markets. Yes, this has fueled markets, but if you just keep on a path like that, you are going to unsettle the markets. You're going to unseat them. And in and of itself, that could cause the next crisis, at least the next slowdown, the next problem.
On the contrary, the more you delay, the more disequilibria you accumulate, and the more you need to make up subsequently. I think that nobody can accuse the Fed of being imprudent. The Fed has been, if anything, excessively prudent, and that's a compliment to the Fed. So I think that if the Fed now decides to do what needs to be done, it will be viewed as a very positive element. And I would not let those people who benefit from exceedingly low interest rate have their vote. We have to worry about the economy in the medium term. The US is the most important central bank in the world. It is the skipper that needs to move our heavy tanker in the right way.
So what about Mario Draghi? What would you counsel the head of the European Central Bank? Because look at the euro. It's the move up in the euro in the month of August has been the biggest August move ever. And traders are saying, investors seem to be saying, doesn't matter what Mario Draghi does, because we know they're going to taper. Strong euro stays. Some people say it's going to move even higher. Is that good? It's going to hurt their exports? Isn't he in kind of a tough spot?
Well, definitely Mario Draghi is in a tough spot, and he is the right man at the right place. He has an extraordinary important challenge because he is operating within a framework in which governments have not given him enough support. So the fact that the euro has changed direction in one way or another, a year ago we were talking about the opposite questions. Let the exchange markets do what they need to be doing. I think it will be a mistake to interfere and prevent the natural adjustment of financial markets. One needs to do the economic policies as steady as you go.
And Jacob, it's Yvonne in Hong Kong. I just want to ask you about China real quick. You've talked about the importance of the integration of the Chinese economy to the rest of the global landscape. But we're seeing the economy doing much better than expected this year. What are we looking out for in the 19th Party Congress? You know, there's talk about loosening capital controls. The U.S., of course, urging an ease of business conditions there. Do they need to?
Well, to begin with, China is a major player today in the world economic system. China is an integral part of it. And you know, the volume of trade between China and the US and Europe taken together is only half of the volume of trade between China and the rest of Asia. The center of gravity has moved to Asia, and China is at the center of it. China has become the most important trading partners of most countries in the world. So it is in this regard that one should not ask how should China loosen or tighten, but rather how do we integrate China more into the economic system. I believe that the initiative that China took in the creation of the Asian Infrastructure Investment Bank is a very important initiative. I believe the US has made a dramatic error by not supporting it and joining it. And I think that the rest of the world recognizes that the place of China in the world economy is central. Infrastructure is good for economic growth and productivity. Linking across countries is essential, and therefore trade interferences are bad. The best prescription to spread the knowledge, the productivity, the innovation from one country to the other is through open markets. So the mindset should be openness rather than closeness.